Hello, everyone. Welcome back to the AI agent version of the new Barbarians podcast. Today, we ran into some technical difficulties, so unfortunately, we couldn't go live with our interview of Lisa Huff and Dan Morrison. But I did manage to get Google's Notebook LM to summarize my recent paper on quantitative crypto investing. So I put together this movie for you to perhaps avoid reading it and gain an understanding with the discussion from two AI agent podcast hosts. And Buster is very tired. So with that, I hope you enjoy it. Thanks a lot. Welcome to the New Barbarians podcast. I'm Bill Mann.
And I'm Mark Connors. We're here to deliver insights on how current macro trends and market events have changed the value proposition on traditional assets like equities and bonds. Bill and I grew up trading and researching over the last 25, 30 years. Instead, we think it's digital assets that are setting the new financial investment frontier for investors like you going forward.
We're also here to explain how cutting-edge tools like AI and disruptive tech are the new barbarians at the TradFi gate.
So hit the subscribe button on your favorite podcast platform, and let's cut through the noise together.
For all the talk about crypto being, well, a purely speculative frenzy fueled by viral tweets and, FOMO, there's this fascinating undercurrent gaining momentum.
Right.
It's the idea of bringing systematic rigor to crypto investing.
Using cold, hard data and algorithms.
Exactly. To navigate what can feel like a really unpredictable market. It might seem like trying to apply logic to lightning, maybe?
Yeah, a bit. But that's precisely the intriguing territory we're diving into today.
Okay.
You sent over this really compelling collection of research, a deep dive within a deep dive, you could say, all centered on quantitative strategies in the crypto space.
So our mission today
is basically to extract the crucial insights from these studies, to see how data science is being used to potentially find a consistent edge in these digital asset markets.
filtering out the hype.
Exactly. Focusing on the evidence-based approaches.
And the scope here, it's pretty impressive. We're talking over 24 peer-reviewed papers.
That's right. Covering everything from adapting classic investment models to, well, the very latest in machine learning.
So a comprehensive look at how serious players are trying to decipher the crypto code.
Absolutely. And as we went through all this information, three consistent themes really jumped out.
Okay.
Think of them as the key landmarks for our discussion today.
All right, what are they?
First, the research consistently highlights that market inefficiencies, they still exist in crypto.
Right.
Particularly when you look at things like price differences across exchanges or between spot and futures contracts.
Okay, let's unpack inefficiencies a bit. So in a perfect market, prices reflect all info instantly, right? No easy profit.
Correct.
So these studies suggest that even with 247 trading, global nature, all that, there are still moments where you can find a mispriced asset.
Essentially, yes.
Yeah.
Like buying low in one place and selling slightly higher somewhere else, almost simultaneously.
Got it. And the second theme?
Second, it's fascinating how adaptable traditional factor models seem to be, in the crypto context, I mean.
Factors like?
Like the size of a crypto's market cap, its recent price momentum, and liquidity, how easily it trades.
Uh-huh.
These have all shown a surprising ability to predict returns.
So it suggests that maybe the same human behaviors around risk and reward,
Yeah.
the ones these factors capture in stocks,
Are also at play in crypto.
Oh, yeah.
That's the idea. Maybe with
Right.
different triggers or different magnitudes, but yeah.
That's really interesting. So forces like small cap, growth potential, winners keep winning, liquidity matters.
Ugh.
These echo in crypto.
The research certainly points that way.
Okay, and the third theme?
The third key theme is the unique and potentially really powerful role of on-chain metrics as signals for future price movements.
Ah, right. This is where crypto's different,
Totally. We're talking data straight from the blockchain itself.
like transaction volumes.
Transaction volumes, active wallets, network growth rates, things like that.
It gives you a level of insight you just don't get with a traditional stock, right?
Exactly. It's like having a secret decoder ring for the crypto market.
But does relying only on that data risk missing, say, broader market sentiment or macro factors?
That's a very good question, and it's one that comes up. You need a balanced view.
It's like looking under the hood, yeah, in a way you can't normally. And it sounds like these researchers aren't just, theorizing in a vacuum.
Not at all. Many of these papers go beyond just the findings.
And so?
They delve into the practical side, implementation.
Yeah.
Some even provide actual Python code to show how these strategies could work.
Oh, wow.
Yeah, one paper we looked at was specifically structured around outlining strategy frameworks and giving, concrete guidance on implementation.
Right. So moving from academic discovery towards potential real-world application. Okay, let's dive into those strategy frameworks then. First up was arbitrage and statistical arbitrage.
Right.
For someone maybe familiar with crypto but less with formal finance, how should we think about arbitrage here?
Okay. At its core, arbitrage is just about exploiting inconsistencies, price differences for the same or very similar assets.
Across different markets.
Across different markets or in related forms, yeah. Think of it like finding, a rare sneaker cheaper on one website than another.
Ah, okay.
The person with the faster connection, faster checkout, they grab it and maybe flip it on the other site.
Right.
In crypto, the classic example is buying Bitcoin on exchange A, where it's slightly cheaper.
And simultaneously selling it on exchange B, where it's a tiny bit higher.
Exactly. Capturing that small difference.
A risk-free profit, basically, if you're fast enough.
If you execute it right, yeah. And the research highlights a couple of specific types. First, spot futures basis arbitrage.
Spot futures basis, what's that involve?
Okay, so this strategy focuses on the price difference. That's the basis between the current market price, the spot price, and the price of its futures contract.
The agreement to buy or sell later.
Right. Usually, futures trade a bit higher than spot.
Okay.
So the strategy is buy the crypto spot, simultaneously sell the futures contract.
Locking in that difference.
Essentially. Now, the research notes that crypto ETFs coming online has kind of compressed this gap, this basis.
Made it smaller?
Yeah, narrower. But opportunities can still pop up, especially during big market dislocations or volatility spikes.
Oh, so when things get shaky.
Exactly. That basis might widen out, maybe from a typical, say, 2% annualized premium to 5% or even more. Makes the arbitrage more attractive.
Got it. So market jolts can create openings there. What about cross-exchange arbitrage? You said those inefficiencies still pop up.
Yes, surprisingly. Despite better infrastructure, more connectivity, small price differences for the exact same coin still appear across different exchanges.
But they must be fleeting.
Right, extremely fleeting. The crucial thing here, and the research really stresses this, is the need for super fast, latency-sensitive execution.
Meaning?
Meaning, by the time a human trader even sees the difference and clicks buy or sell,
it's gone.
It's likely gone. Other bots, other arbitrageurs have already acted. It's a game of milliseconds, really.
Right, fastest reaction wins. Okay, then there's pairs trading and co-integration. That sounds a bit more statsy.
It is, yeah. It's a type of statistical arbitrage.
Yeah.
Pairs trading looks for pairs of cryptos that historically move together.
Like in sync?
Yeah, in a predictable relationship. Think of two friends who usually walk side by side.
Okay.
If one suddenly darts way ahead or lags way behind,
you bet they'll come back together.
That's the bet. You'd go long the one that fell behind, short the one that ran ahead, expecting them to converge back to their normal relationship.
Interesting.
And the research mentioned recent work showing these strategies still work, especially with pairs of layer 1 tokens, the big foundational blockchains.
When?
Particularly during high volatility periods. And interestingly, these pairs trades sometimes even outperform when the broader market is going down.
So it's not about absolute price, but relative value between two linked assets. That's quite different.
Okay, next major framework, factor-based investing. We touched on this, but let's go deeper. How are these classic factors applied to crypto? Sure. So just like in stocks, the idea is to find specific characteristics factors linked to higher expected returns historically.
Right.
In crypto, researchers have adapted this. They build cross-sectional factor models.
Meaning they look across many cryptos at one time?
Exactly. And try to explain return differences based on factors like size, market cap.
Momentum,
recent performance, yeah. And liquidity, how easily it trades.
And there was a specific model mentioned, a 3-factor one.
Yes. Liu, Tavinsky, and Wu back in 2019 developed one for crypto, sort of analogous to the famous Fama French model in stocks.
Using market risk, size, and momentum.
Correct. And more recent work, like Bori and others in 2022, even use techniques like PCA principal component analysis.
A statistical method to find underlying patterns.
Yeah, like finding the main ingredients in a complex recipe. They used it to uncover these fundamental risk components driving crypto returns.
It's pretty striking that these established finance theories seem to have relevance here. What about trend and momentum specifically? Any nuances there?
Definitely some nuances. One study found trend following explains some returns, but doesn't fully capture short-term momentum effects.
Okay.
And another study actually found a short-term reversal effect in most cryptos.
Meaning if it went up yesterday, it's likely down today.
Kinda, yeah. But, and this is the nuance they found, the opposite for the most liquid, large-cap cryptos.
So momentum works for the big, easily traded ones.
It seems so. They suggested it might be linked to liquidity. Less liquid coins maybe snap back after short spikes, while the big ones can sustain trends better.
So not a simple buy winners strategy. Depends on the coin's profile, especially liquidity. That's useful. Did the research touch on diversification benefits, like for traditional investors?
It did. Han et al. Show that adding crypto factor portfolios,
Right.
especially size and momentum ones, can actually provide real diversification benefits to a traditional stock bond portfolio.
Even at a sample.
Even out of sample, yeah. And what's really interesting is using machine learning to dynamically adjust the weights of those crypto factors seem to enhance the diversification even more.
So even traditional investors might benefit from understanding these crypto drivers for portfolio management. Okay, moving on. Sentiment and behavioral models. It definitely feels like psychology drives crypto swings. How are researchers quantifying that?
Exactly. That feeling is what they're trying to measure. The core idea is that the overall investor mood, their attitude, significantly impacts prices.
And how do they measure mood?
Increasingly, using things like natural language processing, NLP.
Analyzing text?
Yeah, vast amounts of text data, news articles, social media posts.
Yeah.
Trying to extract quantifiable signals about collective sentiment. Reading the market's emotional temperature, basically.
So algorithms figuring out if the buzz is positive, negative, neutral.
Pretty much. Some work showed Bitcoin returns do reflect dominant news narratives, adoption, regulation, whatever's being talked about.
Right.
Another study found news about one crypto can actually spill over and affect related coins' prices.
Creating potential trades.
Potentially, yeah. Maybe contrarian trades if the market overreacts to the initial news about that first coin.
Interesting. So if good news about coin A pumps up related coin B too much, maybe coin B is a short.
That's the kind of thinking, yeah. And it's not just news text. Another researcher combined the Fear and Greed Index
Oh, yeah, I've seen that.
with technical indicators and machine learning,
Yeah.
found that blending behavioral insights with technicals improved the model's predictive power.
So capturing that human element adds value. Okay, next. Volatility forecasting. Given crypto's wild swings, predicting volatility seems crucial for risk management.
Absolutely crucial for risk, for position sizing, even pricing options.
And how are they doing it?
Well, one comparison looked at traditional models like HAR models versus machine learning algorithms.
Yeah.
The machine learning models generally did better, especially when they also included sentiment data.
Why sentiment?
It seems sentiment influences volatility in complex, nonlinear ways that ML models are better at capturing.
So ML again showing an edge in handling crypto's complexity. What about volatility clustering or spillovers?
Yeah, one study confirmed volatility clustering in Bitcoin intraday data. So high volatility periods tend to be followed by more high volatility and low by low.
Common in finance, but good to confirm for Bitcoin.
Right. And another looked at spillovers across different Bitcoin currency pairs, like BTC-USD, BTC-EUR.
And found.
Significant spillovers. Volatility in one market definitely affects others, highlights how interconnected the global Bitcoin market is.
Makes sense. Volatility ripples outwards. Okay, finally, algorithmic trading and price prediction. This seems like a huge focus, especially with ML.
It really is. Algorithmic trading, computer programs executing trades automatically.
Yeah.
It's growing fast in crypto.
And ML helps predict prices.
Yes, because crypto prices are so complex, often non-stationary, meaning their statistical properties change over time. ML, especially deep learning, seems better suited.
Better than older methods like ARIMA.
Research consistently shows deep learning approaches tend to outperform traditional stats methods, especially for high-frequency trading. Speed and accuracy are key there.
Any specific deep learning model standing out?
One that got highlighted was NBeats. Neural basis expansion analysis for time series.
Catchy name. What's special about it?
It's designed to automatically isolate trend and seasonality in time series data without needing lots of manual feature engineering.
And the results?
On hourly Bitcoin price data, one study reported remarkable accuracy, an R-squared score of around 0.996.
Wow, 0.996. That's incredibly high, almost perfectly explaining the variance. Are there caveats? Does that hold up in real trading?
That's always the question, isn't it? But it suggests a very strong modeling capability, at least historically.
And you said this was replicable.
Yes. Interestingly, the paper we reviewed included a working Jupyter notebook.
Like the actual code?
Yeah, the code to replicate the NBeats model, and they reran it and got a very similar R-squared score. Adds a lot of weight to the finding.
That's pretty convincing. Any other promising models?
Others, like CNN LSTM hybrids combining different neural network types, also show promise for intraday forecasting. They capture spatial patterns and time dependencies.
Fascinating how fast these advanced AI techniques are being applied to crypto. The research also mentions specialized evaluation metrics. Why not just use standard error measures?
Because in trading, the payoff can be asymmetric.
Right.
You might care more about just getting the direction right up or down than the exact price level.
Especially for directional bets.
Exactly. So researchers are using metrics like directional accuracy.
Yeah.
What percentage of time did the model predict the correct direction?
Makes sense.
And even evaluation methods based on simulated profitability. Does the model actually make money in backtests? That's a very practical way to judge usefulness.
Right. Does it translate to potential P&L? Okay. Shifting gears slightly, the practical side. Implementation. It's not just about having a good model, is it?
Not even close. The research really emphasizes needing robust implementation frameworks, especially for institutions.
Like what?
Well-designed backtesting systems using walk-forward testing to avoid overfitting to historical data.
Simulating real-time performance.
Right, and sophisticated execution filters. You have to account for real-world stuff like transaction costs, exchange limits, slippage.
The messy reality of trading. What about tools? Programming languages.
Python seems to be the dominant language here.
Yeah.
There's a great ecosystem of libraries, OpenB, VectorBeat, BDA for analysis, backtesting, strategy development.
And that NBeats notebook you mentioned.
Exactly. It underscores the practical, hands-on nature of a lot of this research. The tools are becoming more accessible.
Sounds like the barrier to exploring these quant strategies is lowering, technologically at least. Okay, as we wrap up this deep dive, what are the main takeaways for listeners?
Okay, I think three main things. First, despite the hype, crypto markets do have exploitable inefficiencies that systematic strategies can potentially target.
Right.
Second, traditional quant tools, adapted carefully, can be effective for analyzing and trading crypto.
Right.
And third, machine learning, especially deep learning, shows really significant promise for forecasting and strategy development in this space.
And we should also remember,
Oh, definitely remember the importance of things like sentiment and liquidity. They're particularly crucial in crypto and can really impact strategy performance.
so for someone maybe newer to crypto, the message isn't that it's predictable now.
Not predictable, no, but maybe more amenable to systematic analysis than the Wild West image suggests.
So beneath the viral trends, there's this whole world of sophisticated, data-driven approaches trying to find an edge.
Exactly. But, and this is a big but, it's crucial to remember the implementation challenges.
Right.
Statistical validity in a paper is one thing. Real-world profitability after costs, slippage, market changes, that's another challenge entirely.
Yeah.
The theoretical alpha doesn't always translate.
The potential is there, but execution is key.
Got it.
So one final thought to leave our listeners mulling over.
Well, given how fast crypto innovates,
Yeah.
and these studies showing demonstrable alpha opportunities, it makes you wonder, what's next?
Like new data sources, new models.
Exactly. What unique data, maybe from DeFi protocols or entirely new modeling techniques, might emerge to push quantitative crypto investing even further?
That interplay between old finance principles and new digital asset characteristics.
It's a truly fascinating space to watch. It's constantly evolving, and we'll likely see even more sophisticated approaches coming soon. Think about all that untapped DeFi data. How could that be used? It's an ongoing evolution.